Welcome to the deep dive. Today, we're tackling something really central if you're watching the Indian stock market.
That's right. We're looking at futures and options open interest, specifically on the NSE.
Yeah, sounds a bit technical, maybe. But stick with us. Our whole aim here is just to break it down, give you the essentials of what it means and, well, why you should probably care.
Exactly. We're going straight into how these things actually work on the National Stock Exchange. And the big one, what open interest really tells you about market feeling, sentiment, and maybe where prices might be heading.
Okay, let's kick off with futures then. A futures contract on the NSE. What's the absolute core idea?
Think of it like a formal, standardized IOU. It's basically an agreement, right? To buy or sell something could be the NFTY 50 index, could be shares like Reliance at a price you lock in today, but for a future date.
And the NSE sets the terms.
Yep, totally standardized. The contract size, it's the lot size, how many units are in one contract, and the expiry date. It's all laid out.
And it's not just a handshake deal, is it? There's a real commitment involved.
Oh, absolutely. A firm obligation. Both the buyer and the seller have to see it through. What's key here is you don't pay the full value up front.
Ah, the margin.
Exactly. You put down a margin, just a fraction of the total contract value, and that gives you leverage.
Leverage, right. So even a small move in the market price can mean, well, much bigger profits or losses. Can you give us a quick nifty example?
Sure. Let's say Nifty is at 22,000. You decide to buy one futures contract. Let's imagine the lot size is 50 and the margin needed is, say, around €1.
Okay.
Now, if Nifty goes up to 22,500 by the time the contract expires, that 500-point gain times the lot size of 50, that's potentially a 25,000 profit on your margin.
Nice. But the flip side.
The flip side exists, yeah. If it drops to 21,500 instead, you're looking at a 25,000 loss. Leverage cuts both ways, you see.
Got it. Obligation and leverage, key takeaways for futures. So how are options different then?
Options are fundamentally different because they give the buyer the right, but crucially, not the obligation.
All right, not a requirement.
Exactly. You can buy a call option, giving you the right to buy the asset at a set price. That's the strike price. Or you buy a put option, the right to sell at the strike price.
And you pay something for this, right?
You do. You pay what's called a premium to the seller of the option. That's the cost of acquiring that right.
So the buyer has choices. Maybe walk us through that Reliant example.
Okay. Say Reliance shares are trading at 3,000. You think the price might go up. So you buy a call option with a strike price of 3,100.
Right.
Maybe the premium for this right is €50 per share. If the lot size is, say, 250 shares, your total cost, your premium paid, is 12,500.
Right. So what happens?
Well, if Reliance shoots up to maybe 2,200 before the option expires, you can exercise your right to buy at 30,100. You could potentially make a profit there.
And if it doesn't go up, if it stays below 3,100?
Then your option is worthless at expiry. But, and this is key, you just lose the premium you paid, that 12,500. Your loss is capped. You're not obligated to do anything.
Okay, clear difference. Right versus obligation. Premium limits the buyer's loss. Now let's get to the main event. Open interest. What exactly is this number we keep hearing about?
Open interest, or OI, is simply the total count of all futures or options contracts that are still active. They haven't been settled, closed out, exercised, or expired yet. It's the number of open positions held by traders at the end of the trading day.
So every time someone opens a brand new contract, buyer meets seller, open interest goes up by 1.
That's right. And when someone closes out their position, maybe the original buyer sells to someone new, or the original seller buys it back, if that closes both sides of an existing contract, open interest goes down by 1.
And crucially, it's not the same as trading volume, is it?
Not at all. That's a common mix-up. Volume counts every single trade that happens during the day. Open interest only counts the contracts that remain open at the end of the day. You could have high volume but low change in open interest if lots of people are just trading existing positions back and forth.
Got it. Okay, so why is tracking this OI number on the NSE actually useful for, someone watching the market?
Well, it tells you a few important things. First, liquidity. Generally, contracts with high open interest, like Nifty Y50 futures or options, are very liquid.
Meaning easier to get in and out?
Exactly. Lots of buyers and sellers means you can usually trade quickly without your own order dramatically shifting the price. Less slippage.
Okay. Liquidity is good. What else? You mentioned sentiment earlier.
Ah, yes. This is where it gets interesting, especially when you combine OI changes with price movements. For instance, if you see the price of, say Nifty Y futures going up,
Yeah.
and the open interest is also steadily rising.
Mm.
That often suggests new money is flowing in, new
Yeah.
buyers are initiating long positions. It's typically seen as a bullish sign, confirming the uptrend.
And the opposite, price down, OI up.
That can be bearish. It might mean more traders are initiating new short positions, betting on further price declines.
Okay, so rising OI tends to confirm the direction of the price trend. What about when OI is falling?
That tells a different story. If prices are rising, but open interest is falling, it could signal short covering.
Meaning people who bet against the price are now buying back to close their positions, maybe cutting losses.
Precisely. And if prices are falling and open interest is falling, that could be long liquidation. People who bought earlier are now selling to get out.
Interesting dynamics. And for options specifically, does OI tell us something about price levels?
Yes, it can. You often see very high open interest clustered around certain option strike prices. These levels can sometimes act as psychological or even actual support or resistance points.
How so?
Well, think about a nifty call option strike, say 22,500, with huge open interest. The people who sold those calls, the option writers, have a vested interest in keeping the nifty below 22,500 at expiration, so the options expire worthless. Their selling pressure might increase if the price approaches that level.
Ah, so high OI strikes can act like barriers. And what about near expiration?
Yeah, things can get volatile. Sometimes you see pinning, where the price seems drawn towards a strike price with very high open interest in both calls and puts right as expiry hits.
Okay, lots to unpack there. If someone's just starting to look at this, any practical tips for finding and using NSE OI data?
Sure. First, the data is readily available. Check the official NSE website or most good trading platforms will display it clearly.
Right.
Second, don't look at OI in isolation. Always analyze it alongside the price trend and ideally trading volume too. Context is everything.
Good point.
Third, pay attention to those strike prices with significantly higher OI than others, especially in options, and definitely watch how OI changes as the expiration date gets closer. Maybe start by just observing highly liquid contracts like Nifty 50 or Bank Nifty. Get a feel for it.
Makes sense. And the big misconception to avoid.
Just remember, high open interest by itself isn't automatically bullish or bearish. It just means there's a lot of interest, a lot of open bets. You absolutely need to see how that OI figure is changing relative to the price movement to infer anything about market sentiment.
Excellent clarification. So, to quickly recap, futures mean obligation, leverage involved. Options give a right, not obligation, loss capped by premium for the buyer, and open interest. That's the count of active, unsettled contracts.
Exactly. It's a measure of participation and potential liquidity.
And when you track its changes alongside price, it can give you valuable clues about market sentiment, potential support resistance, and what might happen around expiry.
You got it. That's the essence of it.
Okay, great. So here's something for you to ponder. Think about a specific stock or maybe a whole sector you follow. How might tracking the open interest in its futures or options give you a different, perhaps deeper read on what the market expects compared to just watching the daily price wiggles? What new questions does understanding open interest raise for you about market psychology and anticipation? Worth thinking about. That wraps up our deep dive for today.
Until next time.